Welcome to Nasdaq Trade Talks. I'm your host, Jill Malandrino, global markets reporter at Nasdaq. Joining me at the market site, we have Ivan Feinseth. He is the chief investment officer at Tigris Financial Partners, and he thinks trade pullbacks could be a great buying opportunity. It's great to have you back with us,
Thank you,
Ivan. And let's run through some of the things that you see as potential catalysts on any pullbacks. M&A is remaining strong.
Yes, we saw this deal now between Fiat, Chrysler, and Renault. The third big payment processing deal between Global Payments and Total Systems Services. Those were two big deals. Those were, $32 billion and a total $40 billion deal. So I think that any weakness in stock prices, if you're looking to acquire, is an opportunity. Mm-hmm. And I think, as we've seen so far, any of these trade-related pullbacks have been buying opportunities.
Well, I mean, the market certainly remains susceptible to trade tweets. Do you think they still have the power behind them to turn this market around?
I think President Trump could turn this market with a tweet that says we're sitting down at the table. I think what happened, that there may have been some perceived pullback by President Trump of China, and he's just the type of negotiator that will get up from the table first. He's kind of the ultimate Soviet negotiator, walk away first. And I also think he's been emboldened by the strong GDP number we had in April and the strong unemployment number we had. That I think the market made an all-time high. I think he could afford a little bit of a pullback. I don't think he wants too much of a pullback because he also has said many times the stock market is how he wants to be judged.
Right.
And I think it is accurate. I mean, if the stock market's a forward-looking indicator. If there's confidence in the economy, people are going to put their money in stocks. If there's confidence in the administration, people will put their money in stocks. If there's not, they won't. So I think it is accurate. But I don't think, especially going into election year, I also will say this: if we have a strong economy and a strong stock market, Trump will get reelected. If we don't, he will have a hard time.
Yeah, well, I mean, he's going to have to hinge his bets on that.
Yes,
in terms of what's been accomplished with his administration.
Pretty much all he has to go by.
Right, exactly. I'm going to push back a little bit, though. There are some other global macro indicators, though, that are suggesting a tweet might not just save the market. I mean, look at the conversation we're having today. Again, we're looking at bond yields, and then, of course, other global macro indicators. It's not quite as strong as it may have been in the beginning of his administration.
Well, I'm shocked that we have had the decline in yields that we've had, and I don't think it's economically related. I think it is risk-on, risk-off trade, complex strategy related, whereas there could have been a huge short position in the bond market. People are now scrambling to cover. Or the fact that, I mean, one of the retaliatory things that people could say China could do to us is, dump their treasuries. Well, that would first only hurt them. Second is, it's obviously not the case. And we just had a 2-year bond auction that had the strongest interest in over 6 months. So there's still record demand for U.S. treasuries. It is kind of crazy to see the yield curve inverted the way it has. That would, again, say that a recession is imminent, within 6 months.
But that's only one indicator.
Well, but it is, in theory, a powerful indicator. Right. I think you will see the bond market unwind, the yields go back up, and it is in both countries' best interest, and they both need to have a trade deal. I mean, with the two world's largest economies, then they have to work together. And there's already concerns that tariffs are going to start to slow down global growth, and companies are going to ratchet down results, which could have a negative impact. And if Trump wants a strong stock market, he needs to have everything in place now for a strong economy in 18 months from now.
Right. Well, that is a good point. But let's wrap it up here with buyback momentum. It's been a really strong pace this year.
Yes. And the whole thing is that companies continue to generate excess cash, especially today's world-leading companies like Apple, Google, Facebook, that are what I call intellectual capital intensive, and they're not financial capital intensive, so they throw off excess cash that they are returning to shareholders at a rapid pace. And we just have so many companies that have become so efficient that they generate significant excess cash, and we've seen record increases in dividends and record stock buybacks, which are helping the economy. Helping the stock market, and it helps the economy.
Of course, it certainly has been a positive for stock prices. Are you concerned at all with money going to buybacks and dividend increases, that there's not enough money going into R&D? How are they going to provide for future growth?
That is a tough thing, because you want companies to invest in R&D, but I mean, I follow return on capital. And to me, the biggest driver of shareholder value creation is an increasing return on capital, what I call increasing economic profit, which is your return on capital over your cost of capital. The more that spread widens, the higher your stock price will go. So companies have to invest in the future. They have to invest in incremental projects that have a positive return. And they also have to continue to invest in research and development. But companies are. I mean, look, Microsoft, Google, Facebook, Amazon. I mean, all of these tech companies, they are hiring like crazy. They are investing in R&D like crazy. Even Lyft and Uber, the future of their company, they said, is on autonomous technology. So that is a big thing. Even though I always say we like the idea of the self-driving car, but we've all seen Terminator, so we know how it could end. But they are spending a lot on R&D. And yes, companies that forego R&D to juice earnings per share or juice their share buyback eventually do suffer. So you do want to see increases, especially in tech companies, spending on R&D, but also buying back stock.
All right, Ivan, as always, thank you so much for joining us.
Thank you.
All right, and thank you for joining me on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.